Hello, friends. James Stevenson back with part 3 in my series on Stephenson Indicator. So if you haven't seen parts 1 and 2, go watch those first. Those were about the history, the background in part 1. And then in part 2, I went through how I duplicated the work I had done already in Excel using a Google Sheet that you can access live on the internet to see more detailed info by day. All right, part 3, I promised, would answer the questions: how has this technical analysis indicator been working so well over the past 2 years? Why has Tesla's share price been increasing at about the same rate? And I'll put the same disclaimers on this video as I have on the others. This is for entertainment purposes only. I'm just talking here about a company that I'm invested in. Full disclosure. You can follow me on Twitter. Let me share my screen and we'll look at what James is looking at today. So I already tweeted out part 1. Part 2 is now available. Part 3 you're looking at right now. So you found it. Let me take you to the Stephenson Indicator visual by following the link that I tweeted out a couple of days ago so you can see what we're talking about. The vertical lines that you see here are showing you the difference between the actual closing price on each day and what this technical support line is that I've been calling humorously Stephenson Indicator TM, trademark James Stevenson. So for a long time, it was trading at or above Stephenson Indicator. And then very recently here, there has been a sale where lucky Tesla buyers have been able to get it at a discount to Stephenson Indicator. So what's going on here? How has the market's perceived valuation of the company kept increasing at this rate? And to answer that question, I have to talk for a minute about a crash course in company valuation. How do you know what any company is worth? Right? This is a question that they ask in MBA school. And what I'll do is run you through the very fast abbreviated version of that lesson. So I'll get rid of both of these and I will bring up my earnings model. So this is the same earnings model that I tweet out a couple of times per quarter as I update my forecast for Tesla's earnings. And I've just drawn up a few examples. I did this in advance so you wouldn't have to watch me make the spreadsheet, right? So how do you value a company at all? This is my little crash course. So we have 4 different examples. Try not to get ahead of me. I got them all to fit on one page. So let's go through them one at a time because there's a whole lot of different kinds of companies in the world, but I've shown 4 examples here of different kinds of companies. Let's talk about company number 1. So their situation is that they are a liquidation story. So this company headquartered in Germany, we're going to call the company BAMF, is going to be bankrupt soon. That's their situation. And the business they're in is selling luxury ICE and hybrid vehicles. That's what business they're in. So how do you know how much you should pay for a company that's going to be bankrupt soon? Well, the approach that is recommended by many in this situation is to figure out what the liquidation value of the company is. How do you get that? You ask the question, what can I get chopping up this company into small bits and selling it off? So companies have assets. They have receivables and they have factories and they have cash, right? So if I were going to try to sell off all of those things the company has been investing in over the years, how much money could I make? So here I have said for this example, $190 billion might be raised by selling off all the assets of this company. Then the next question is, how much does this company owe in total? Like, how much does it have to settle to get all of its creditors off its back from all the money it's borrowed, et cetera? So if you believe $150 billion would settle all outstanding claims against this company, then you believe the valuation of this company is $40 billion. So you wouldn't pay more than that much because that's the maximum amount of money you would have left over after selling off the company. All right, so that's one example of how you might value a company. There are, of course, hundreds of potential ways that you could draw up the math for how much should I pay for a company. These are only 4 examples and they won't fit every situation. Let's move on to company number 2. Okay. Company number 2 is a no growth company. That's the situation that they're in. They're not growing. They are headquartered in the USA. The name of the company is Geriatric Motors. Their earnings have stalled and are not expected to grow. And the business they're in is selling ICE trucks and SUVs. That's how they make money, is selling internal combustion engine trucks and SUVs. So how would you value this company? And a lot of companies are in this maturity phase of their life cycle where their earnings aren't growing, but they are profitable, right? There is money being made. So what you could do is look at their most recent year's adjusted EBITDA and say, okay, they made 21 billion worth of adjusted EBITDA last year. What's a good multiple to pay on this company? And what you want to include in your multiple calculations is, okay, we need to adjust for the time value of money. Money today is worth more than money later. So even if this company continues to make profits for a long period of time, if those profits are not growing or potentially eroding over time, the money's worth more today than it will be later. So you need to factor this down or discount back the cash flows to present value. The other one is the risk. How secure are these earnings? Is there a potential that these earnings are going to go away completely? If there is, then you want this to be a lower multiple, right? So I've got a 2.5 multiple in here. So if you believe 2.5 is a reasonable multiple to put on the adjusted EBITDA, then you believe this company should be valued about $53 billion-ish, somewhere in that ballpark. That's what you wouldn't want to pay more than that much for this company, right? All right, let's go to another example. So example number 3 is a hypergrowth company headquartered in the US. The company name we'll call X. Seems like a good name for a company or person or a name for a part of a company or a website. I don't know. So the headline for this company is they've got profitable earnings. They're profitable already, and they have hyper growth on those earnings, right? Their earnings are growing not just a little bit, but a lot. And the business they're in is selling luxury EVs, energy, and AI, just as a hypothetical example of a company here, right? So let's look at the earnings here. And earnings, I mean, when you hear that a company is reporting their quarterly earnings, why are they calling it earnings? A whole lot of numbers get reported on the financial statements, right? Why isn't it called the balance sheet report? Why isn't it called the gross margin report? It's called earnings because earnings is the metric most closely tied to valuation. Wall Street cares how much your earnings are because they're applying multiples to those earnings and to the earnings growth to figure out what the stock price should be. Their stock prices are based on the earnings amount. So when earnings beat, then they usually want to raise their stock price. When earnings miss, they usually want to lower their stock price from what they had previously believed, right? So let's say this hypothetical company will grow their earnings from $6.78 per share over the trailing 12 months, that is the 12 months ended December of 21, to $19-ish over the next 12 months, which is calendar 2022. Well, that would be 181% growth. How did I get that number? It's just this number divided by this number minus 1. So how much is the growth percentage of this EPS compared to that EPS? Well, then, according to a guy named Peter Lynch, who was a very successful investor, you can read all about him separately. I don't have time to go into a lot of background on him. The growth matters, and the rate at which a company is growing ought to support your decision to purchase at a particular PE multiple. So you can't look at PE in isolation. You need to inform your PE purchasing decision with what the growth rate is. So the calculation that I have here is saying 100 times this earnings percentage times this base EPS gets you a price target of 1,228 for this company, 1 year price target. So the diluted shares for this hypothetical company are 1.135 billion, giving an estimated valuation in billions of dollars. About $1.4 billion is what this company would be worth using these assumptions, right? So let's bring this back to Stephenson Indicator. How much does Stephenson Indicator go up per trading day? It goes up by $1.69. How many trading days are there in a quarter? There's 63 3/4 days in a quarter because of weekends and market holidays. It's a different number each quarter. So how much is the market cap growing by per quarter on the Stephenson Indicator chart? So if I go back to this, what does this $1.69 per day of growth tell me about the valuation of this company? It tells me that the company's value is growing by $122 billion per quarter. All right, so what I'm going to do next is going to blow your mind because these are linked to my detailed model. So each of these is linked to this next tab over, the detailed model of my forecast spreadsheet. So what I can do with this is grab it and drag it backwards 4 quarters. And I can drag it forwards 4 quarters. Or 8 quarters. All right. And some of these aren't displaying very well right now. So I'm just going to change the font size on that. And then these did not drag properly. So I'm just going to copy and paste those and fix this. See, this is why I do this stuff in advance. So you don't have to watch me work on a spreadsheet. All right, so the amount of diluted shares changes a little bit over time, which is what causes this $122 billion worth of valuation to fluctuate around a little bit. But the place that I want to draw your attention to is this last dark gray line, the estimated valuation line. If you had done the same math using the same calculations a year ago, so at the end of 2020, it would have told you the company was worth 511 billion. So let's fast forward to now. You know, it's up to 1.4 billion. Let's go forward another 2 years to December of 23, 2.5 billion almost, right? So the company is getting more valuable over time because the company's earnings are growing so much over time. Now, you'll notice that these percentages are smaller out here than they are over here. That's just because these amounts are very small and easy to get a big multiple over, right? So if your 12 trailing month EPS was only $2, it's pretty easy a year later to come in with a $7 EPS. That's only $5 worth of growth here. If you get that same $5 worth of growth at the end of 2023 over a $19 base, that's not a very impressive percentage anymore. But the math still holds. The bigger this base number gets, the trailing 12-month EPS, the bigger the valuation gets, even though you're applying a smaller growth percentage, which is why these amounts are higher than these amounts. So that's the story. That's why Stephenson Indicator has been a pretty good proxy for the company's stock price over the years, and may continue to be a pretty good proxy for where the closing stock price ought to be going forward, because Tesla, the company, is getting more valuable. How are they doing that? By growing their revenues, by growing their automotive gross margin percentage, and by gaining operating leverage, controlling costs below the gross margin line, and by introducing new products that are also very good at generating revenue profitably. So that brings us to the end. No, it doesn't. I got one more company to cover, don't I? Okay, sorry, false alarm, false ending. So there is one more example here that people will beat me up if I don't cover. So this is a struggling startup. They are based out of Saudi Arabia, and the name of the company is Al Usid. So this company does not have earnings yet, and they make luxury EVs. This is another situation that a company might be in. You know, startup companies don't have earnings because they're too small and they haven't grown yet, right? So how would you value a company in this situation? They're losing money. So these valuation, metrics are not going to work. So what do? Well, you look at the total addressable market. So a number that you might be curious about first is, okay, how many new cars are being sold per year? They sell new cars. How big is that market? Well, 75 million vehicles sold per year worldwide. All right. But of those 75 million, how many are over $100,000 each? Well, it might be 3 million. And then how much of that market can this company take? I have plugged in 5% here. You can argue with me over that number if you want. Maybe they can take 5% of a 3 million market for cars comparable to the car they sell. So that would give them 125,000 cars sold per year. Actually, let me do this divided by this times a million. Okay, so that's 4 point. What do I need to do here? Fix this. Yeah, there we go. All right, I changed my assumption and then I forgot to update it. So let's call it 4.2% instead of 5%. So if you're following along at home, your math will also work. So you call it 4.2% market share, you get 125,000 cars. And let's say this company can make a $20,000 profit at the gross margin line. So after covering the expenses of, $100,000 car, $150,000 car, whatever they can sell it for, after covering the factory production related costs of producing and delivering that car, they've got $20,000 worth of gross profit left. Then they've made gross margin of $2.5 billion per year off those 125,000 cars that they sold. Then let's look at their fixed costs. So these are all the costs not related to producing vehicles. This company's run rate is $2.4 billion worth of fixed cost, R&D, SG&A, stock comp, et cetera. That's going to leave them with 0.1. Let me fix my decimal on this one. There it is. $0.1 billion worth of earnings per year. Now, if they can grow that at, let's call it 20% per year, then they're worth $2 billion. If they can grow it at 50% per year, they're worth $5 billion. If they can grow it at 100% per year, they're worth $10 billion. Take your pick. So that's another method by which you could value a company. And that's my crash course in valuation. And now I'm done. All right. I do these videos live and I don't edit them. So it's kind of like a live stream in that way. All right, let me stop sharing and I will come back to full frame and say, if you have enjoyed this video, click the like button. If you're not subscribed to my channel already, you can click subscribe or not. It's your life. Do what you want. And I will see you in the next one.